Some basic risk management strategies. Okay, so when it comes to trading, guys, you should have some sort of rule as to how much you're willing to risk per trade. The reason this basic risk management rule exists is so that it prevents you guys from becoming emotional when trading. Trading is very emotional, whether you're excited, or anxious, frustrated. If you're sitting in a loss for a certain amount of for a certain length of time, it really has an impact on your psyche. So it's very important that you maintain a rational mind frame every time you make a trade and get into trading. And so that's why I'm sure you guys have heard this before, there's a 3% trade risk rule. So meaning, you should only risk 3% of your entire account per trade. Okay, so for every $1,000, the max that you should risk is $30. Okay, because that's 3%. Now, when making a trade, and the max that you can risk is $30, well, then you should only be trading 0.1 lots. Okay, so when you go in and you make a trade here, you should be trading 0.1. Okay, because when you trade 0.1, that's what's known as a mini lot, and a mini lot, you're basically trading $10,000. Okay, we already went over leverage in the previous lecture, so I don't need to explain that you don't actually need $10,000 of your own equity because of the leverage in your account. But basically, when you trade a 0.1, you're trading a mini lot, and for every one pip, it's equal to $1. So for example, let's just go ahead and make a trade here. Okay, so let's go ahead and I'm gonna buy this. Actually, I'm gonna close out this trade here. Okay, so I just bought Aussie USD, and I'm gonna scale this down to a 5-minute time frame, and you can see in the bottom that it's negative $2.90. Okay, and because I bought this, if this pair starts to fall off, we'll be sitting in a negative, so I can risk $30 per trade. And when I trade 0.1, I can risk $30. So I'm just gonna go ahead and drag this dotted line down a little bit until I get to the $30 range, and there we go. Okay, so that's 37. So the max that I can risk is roughly around this area here. Okay, so there we go. So 29.80. Okay, so if this pair continues to fall and I get stopped out, I lost $30. That's the max risk that I should be taking for any given trade. Now, you might be wondering, well, I don't want to put my stop loss there. Okay, I might want to put my stop loss even lower. You might want to consider putting your stop loss below this recent low here. Okay, so now if I were to get stopped out, well, I'm risking $55.30. Okay, so if you live by the 3% trade rule, you should not have executed a buy position up here and put your stop loss down there. You should have more discipline, more patience to wait for a better trading opportunity to get in. So for example, if this were to continue to fall down to this declining level of support, so if it fell down to here, then this might be a good buying opportunity, because from here down to here, well, that's probably about the 30 pip risk allowance that you have. Okay, so buying it up here, that's a little too early. So you have to have that trader discipline and wait for certain price points to hit, and then get in and put in your max 30 pip risk. Okay, that's only if you guys are trading by the 3% rule. I highly recommend not going over 3%. 4% is the max that I wouldn't even go to 4% actually. 3% I think is the most, because it's all about maintaining a rational mind frame, like I said. Okay, it's also very important, like I mentioned earlier, guys, that you are putting in stop losses. Okay, Let's just take a look at Euro USD. And the reason for that is because, you know, if you thought, for example, this was like some sort of high, you know, I'm just saying, like if you thought, you know, 1.0864 was a high price point for Euro USD, and you decide to get into a short position, so as this pair starts to sell off, you're making a profit, but if this pair continues to go upwards, you'll be sitting in a loss. So it's important that you guys are putting in a stop loss, because, you know, if you did not put in a stop loss and you got into a short position, well, as this pair continued to climb up, you'd be sitting in a bigger loss as the days went by. And this is when you can start to become very emotional, you know, especially if it's a large position. So, you know, it's best to get stopped out, reanalyze, wait for a better price point to get in, and then take another shot at it. Okay, I'm not going to go into details just yet, because you guys watching these videos are very new to Forex trading. But in these sessions coming up, I will be introducing you guys to some very, very highly profitable strategies that I use when it comes to you know, waiting for the right opportunity, waiting for lots of confirmations, and then deciding to get in. So, for example, I'll just quickly touch upon it right now. You know, if you were waiting for a good opportunity for this pair to short, you know, there's no point in shorting it just because you think it's a high. You know, there's a lot of traders out there, they think, oh, you know, this is a, you know, you're trading just based off of what the price is. You know, ignore the price. You know, you have to wait for lots of confirmation. So there's no point in trading this in going into a short position unless this rising trend line has been broken. Right? So now that we finally saw this trend line break, well, now this might be a good opportunity to start shorting it. You know, and the reason for this as well is because you're able to manage your risk, you're able to know where to put in your stop loss. And what I mean by that is, if we were to draw out this trend line even further, okay, so one of the confirmations why we decided to get into a short position was because this trend line broke. Okay, and so if this pair continues to climb upwards and breaks back above this, which was support and is now resistance, if it breaks above this trend line as resistance and goes higher, well, that's where we want to get stopped out. You know, because this was one of our confirmations of going short. Okay, so that's just, you know, I just want to basically give you guys the basics of risk management. It's all about, you know, staying rational and you know, maintaining being consistent with your trades. So 3% is the max that you guys should be trading or should be risking per any given trade. Okay, so that's it for this video, guys. Be sure to not watch